Hi, everyone, and welcome. Thank you so much for tuning in to the 2025 Tax Act update brought to you by the team here at Financial Solution Advisors. Today, we're unpacking a piece of legislation with quite the name, the One Big Beautiful Bill Act, which is commonly referred to as OBA here in office. We'll take a look at the new legislation and break down how it might impact you from both an individual and business standpoint. I'm Austin Franks, a tax associate here at FSA, and I'll be your host for today's session. I'm honored to be joined by one of our firm's best and brightest minds here to guide us through all the relevant takeaways. Presenting today is Erin Golotko. Erin is a senior tax manager here at FSA. She holds a Bachelor of Science in Accounting from the University of South Florida, a Master's in Business Administration from Florida Southern College, and is a licensed CPA with more than 7 years of public tax experience. Outside of work, Erin is a loving dog mom to a golden retriever and 2 German shepherds. So whether it's tax advice or dog training tips, Erin's got you covered. Once Erin wraps up, I'll return to close things out. With that, Erin, you want to take it away?
Thank you, Austin. I hope you all are ready for some riveting tax updates. Let's get us started. So the One Big Beautiful Bill, or the Tax Act of 2025, is the most significant tax legislation passed since the 2017 Tax Cuts and Jobs Act, otherwise known as the TCJA, which you'll hear me refer to often. This act makes many of the changes from the TCJA permanent, sunsetting some of the incentives, and introduces new deductions and credits. Most of these changes begin after December 31st, 2025, unless otherwise noted. So let's start out with the impact to the individuals and the post-2025 Tax Act individual tax rates. The 2025 Tax Act made the TCJA tax rates permanent. So you'll see in the chart that the pre-TCJA tax rates are the same as the post-2025 Tax Act rates. Had this bill not been passed, we would have seen an overall increase in tax rates. The middle column in this table here, you can see that the maximum tax rate would have been 39.6%, but we are good here. We have a range of rates that remain the same as the TCJA from 10% to 37%. In addition, the 2025 Tax Act retains the 0, 5, 15, and 20% preferential tax rates for capital gains and qualified dividends. We have provided a table here with the preferential tax rates by filing status. This is just a high overview. If you have specific questions, of course, reach out to your CPA, but these are just some quick points on the preferential tax rates. All right, so the TCJA tax brackets for married filing joint are now permanent thanks to the 2025 Tax Act, and they are twice the single filer amounts. The only bracket this does not apply to is the top bracket. The alternative minimum tax, or AMT, is a very complex tax subject, so I'll just touch on it very quickly. And again, if you're concerned or have questions, please reach out to your CPA. The AMT exemption amounts and the phase-out thresholds are permanently increased. Now we're going to move on to the standard deduction. The standard deduction is permanently increased with inflation adjustments, of course. Had this bill not been passed, we would have seen standard deductions drop drastically. The standard deductions have all increased for 2025. The single filers have a standard deduction of $15,000, and married filing joint have a $30,000 standard deduction. The standard deductions do increase for taxpayer and spouses over the age of 65 and for those who are blind. Personal exemptions for most taxpayers are permanently eliminated. On the next slide, we are going to discuss the exemption to this statement, the new senior deduction of $6,000 or $12,000 for married filing jointly. That is in the middle of this table. It is new. It is for seniors age 65 and over. And we'll talk about the specifics here next. So in the early iterations of the bill, lawmakers had discussed no tax on Social Security. This was definitely a popular discussion. That did not pass, so in lieu of the no tax, they created the new senior deduction. So Social Security income remains the same, but there's a new deduction for qualifying seniors. For tax years 2025 through 2028, qualifying seniors will receive a $6,000 credit. The taxpayer and the spouse will each be eligible for $6,000. So if you are married filing jointly, you will receive a $12,000 deduction on your 1040. There is an AGI phase out, so the higher your income goes, the lower the deduction will be. The deduction will never go below zero. So if your income does get to a certain level and you no longer have the deduction, there will just be a zero deduction. It is important to note that this is not a permanent provision. It is temporary and is set to sunset in 2028 unless new tax provisions are passed. So we'll just have to wait and see how this turns out. So if you're an eligible senior, 65 or over, we highly recommend scheduling a meeting with your CPA to discuss your tax situation and do some tax planning. This is going to impact a lot of people who do receive Social Security income. So go ahead and get ahead of that before the end of the year. Before we move forward, I want to discuss the difference between the itemized deductions and the standard deductions, just high level, because this next part of the presentation does have to do with people who have itemized or standard deductions. So I just want to make sure we have a quick high level understanding. So taxpayers either deduct the standard deduction or the itemized deduction, but not both. We discussed the standard deductions previously. These are the fixed dollar amounts that depend upon age, filing status, and other factors. The standard deduction is often more advantageous for those who do not have significant deductible expenses. So what are these deductible expenses? They include medical expenses, charitable contributions, mortgage interest, state and local taxes. And these are considered itemized deductions. So if these various deductions exceed your standard deduction amount, you can take the itemized deductions. I think this will make a little more sense when we talk about some of the changes in the itemized deductions later in the presentation. You are also going to see there are a few new tax provisions in the 2025 Tax Act that are available to both an itemizer and taxpayers taking the standard deduction. All right, so the first one we're going to talk about is the state and local tax, also referred to as the SALT deduction. So this is an itemized deduction, and it comprises of property taxes, state withholding taxes, state income taxes. So in previous years, the SALT deduction had been capped at $10,000. So this new bill now has a SALT deduction cap of $40,000 for 2025, which is great news. Of course, they're going to be phased in increases and phase outs for high income taxpayers, and it is a temporary adjustment. So the deduction will revert to $10,000 in 2030. Phase outs begin for married filing joint taxpayers with modified adjusted gross income over $500,000. But rest assured, if your modified adjusted gross income is over $500,000, married filing jointly and continues to increase, your deduction will not go below the $10,000. So there is a $10,000 floor for this deduction. As many Floridians know, we do not have a state income tax here in Florida. This is really going to benefit our clients who live in another state where they have to pay state income taxes and they have the state tax withholding. So I think it's going to definitely benefit those out of Florida taxpayers. So I'm interested to see how that turns out. This is just a quick summary of the SALT deduction caps through 2029. Again, this is a temporary tax provision. So in 2030, this will revert back to the $10,000 cap. For tax years 2025, the SALT deduction cap is $40,000 married filing jointly and $20,000 married filing separate. And the phase out threshold begins at $500,000. Each year, the SALT deduction is indexed for inflation, and the phase out thresholds increase slightly as well. All right, another itemized deduction featured in 2025 Tax Act is the mortgage interest deduction. The TCJA, the Tax Cuts and Jobs Act, introduced the cap on mortgage interest for acquisition debt exceeding $750,000. This deduction cap has been made permanent. The cap also remains for those with grandfathered debt. Grandfathered debt is debt incurred on or before December 15th, 2017, and that cap is 1 million married filing joint, 500,000 married filing separate. The mortgage interest deduction applies to your primary residence and one other qualified residence. For those with multiple vacation homes that are personally used and not rented, you can only deduct mortgage interest on 2 residences on your return if you itemize. This only applies to your itemized deductions. This does not include your rental properties. The piece limitation has been repealed. This is the reduction to itemized deductions for high income taxpayers. So there is now a 2% reduction to itemized deductions. I won't go into details here. It's case by case. If you have questions, this is very high level. Please reach out to your CPA. Mortgage insurance premiums are now permanently deductible as qualified residence interest paid if it's in connection with the acquisition debt where you're already deducting the mortgage interest. The mortgage interest premiums are subject to an income-based phase out, so not everybody will be able to deduct these, but some people will. Charitable contributions, there has been a huge change with the 2025 Tax Act for both standard deduction taxpayers and itemizers. So new with the 2025 Tax Act is a $1,000 for single filers or $2,000 for married filing jointly deduction for charitable donations. This applies for tax years after 2025. So coming up this next tax year, if you did, donate more than $2,000 to a charity and you do not itemize, you are eligible to take a deduction. So again, this is a deduction that can be taken if you take the standard deduction or the itemized deduction. So this is a great new part of this bill. For those who do take the itemized deductions, you are eligible to use that $2,000 deduction. But if you do also itemize, you have a permanent 60% of AGI ceiling for cash donations. So it is permanent, it's not going away. So for the cash donations in excess of the 60% limitation, those can be carried forward for up to 5 years, not 25 years, 5 years. And you can continue to deduct them if you are eligible in the next 5 years. The Tax Act did introduce a new 0.5% AGI floor on charitable contributions. So basically, your charitable deductions will be reduced by 0.5% of your AGI. This floor applies to both current year donations and carry forward donation deductions claimed in the current year. This does not apply to non-cash contributions, only the cash contributions or the cash donations to charities. Disaster-related personal casualty loss rules are a very complicated subject and should definitely be discussed with your CPA if you do have hurricane-related losses, flood-related losses, anything like that. As residents of Florida, we are used to hurricanes, and I feel like we have become very familiar with the casualty loss rules after the hurricane season we had last year. The Tax Act has definitely made the casualty loss rules more accessible. Previously, in order to deduct the casualty losses, the president had to declare a disaster and determine that there was a need for federal assistance. This was very common last year with the hurricanes that hit Florida. Now, with the new Tax Act, the qualified disasters can be either federally declared or state declared. If the state determines there is a need for assistance, we can deduct casualty losses there. It doesn't have to be decided by the president. In addition, the $500 per casualty floor and no AGI limitation rules have been made permanent. These casualty loss rules do benefit all taxpayers since both standard deduction and itemizers may take the deduction. Another hot topic is the no tax on tips. For tax years 2025 through 2028, there's a new temporary deduction for individuals who receive qualified tips and occupations where tips were customary before January 1st, 2025. That was a mouthful, but they really are going to be strict about who is actually receiving tips. Another key point for this deduction is it is a $25,000 per return deduction, not a per taxpayer or per spouse per return. So for those joint filers, the limitation is $25,000 per return, not per spouse. Like the other changes we have discussed, the deduction will phase out for those whose income exceeds $150,000 for single filers and $300,000 for married filing joint. To benefit for this deduction, you do not have to itemize. You can take this deduction even if you use the standard deduction. So everybody can take this deduction if they are eligible. If you are married, you must file jointly to claim the deduction. So it sounds like this deduction is not an option for those who are married filing separately. Of course, the IRS wouldn't want them to take advantage of the $25,000 per return rule. The IRS will be releasing a list of occupations that qualify for the qualified tips deduction. So no, unfortunately, you cannot just decide to start paying tips at your legal firm or your CPA firm. It's going to be regulated. So I'm interested to see how they are going to regulate that and what that list is going to look like. As a taxpayer, you will not have to worry about reporting. Employers and payroll companies will be in charge of properly reporting the tips. In order to receive this deduction, the tips must be properly reported on the IRS-approved tax forms. We do not know what they're going to look like yet, but we do anticipate changes will need to be made pretty quickly to comply with this upcoming tax season. There will be some interesting updates coming from the IRS. One interesting part of this bill is it specifically says cash tips. So I don't know if you're like me, but when I go get a coffee, go to a restaurant, and I pay with a credit card, I most of the time leave a tip on my credit card. So I am interested to see how the IRS is going to come out and define the qualified cash tips. If even though it says cash tips, hopefully it includes what I put on my credit card too. And then we also have a deduction for qualified overtime compensation. So similar to the no tax on tips, the no tax on overtime was a very hot topic. The Tax Act of 2025 has created a deduction where taxpayers can deduct up to $12,500 per year in a qualified overtime pay that is required under the Fair Labor Standards Act. For joint filers, it is $25,000 per return. There's an important distinction here between the tip deduction and the overtime deduction. Tip deduction was $25,000 per return regardless. This is $12,500 for taxpayer for a spouse. They each get $12,500. Similar to the tips deduction, you do not have to worry about the reporting. Employers and payroll companies will be in charge of properly reporting your overtime. This deduction is also for everyone if you're eligible. You do not have to itemize in order to take advantage. It also has the same modified adjusted gross income phase out as the tips deduction, $150,000 for single filers and $300,000 for married filing jointly. Another caveat to this deduction, you cannot deduct amounts already claimed as qualified tips. You can take both deductions, but the income must be properly differentiated. So that's going to be really important with these payroll companies and with your employer properly reporting this income. A new temporary deduction, the auto loan interest deduction, is available for those who use the standard deduction or the itemized deduction. So if you buy an American-made car, you can take advantage of this deduction, whether you itemize or use the standard. So this is for all taxpayers. The IRS has outlined which cars will qualify. The vehicle must be new, under 14,000 pounds, and the final assembly must be in the US. In addition to the vehicle requirements, the loan must have originated after December 31st, 2024. Original use must have begun with the taxpayer, so transferring your business vehicle to your personal name probably is not going to work. In order to claim the deduction, you will have to provide your CPA with the vehicle identification number. This is required to be reported on your return. Your return will not be able to be e-filed if we do not have the VIN for your new vehicle. So the IRS is going to be keeping track of a lot of this information. You do not need to personally keep track of the interest paid because your lender will provide a tax form. And this tax form we're anticipating is going to be very similar to the 1098 that you receive if you pay mortgage interest. It will be reported to the IRS and then we'll report it on your tax return. Some good news for those with 529 plans, the saving plans for education expenses. The new Tax Act expands the definition of K through 12 qualified education expenses to include curriculum books, tutoring, standardized test fees, and a lot more. Also, the annual limit for K through 12 expenses increased to $20,000 from the $10,000. So you can take a distribution of $20,000 now, and the total contribution limits are not impacted. So this is a big change for those that use the 529 plans for K through 12 expenses. The 529 plan distributions can also now be used for post-secondary credentialing expenses. This was a big change for post-secondary expenses and big news for people who are studying for the bar exam, who are studying for CPA, because they will be able to use their 529 funds to pay for these fees. This is effective for distributions after July 4th, 2025. So this is another important date to keep in mind when you want to take these distributions for post-secondary credentialing expenses. One of the most talked about credits is the child tax credit and dependent credit for qualifying children under the age of 17. The TCJA, Tax Cuts and Jobs Act, initially introduced the child tax credit, and the new Tax Act has now made the credit permanent. The child tax credit is now enhanced and extended with higher refundable amounts and expanded eligibility. The other dependent credit for dependents that are not eligible for the child tax credit has also been made permanent. Taxpayers receive a $500 credit, and that one is not refundable. There are still some income phase outs that have to be considered when calculating the credit, but these phase outs are not indexed for inflation, so they are going to remain the same. And in the table we provided, you'll see that amount per dependent for the child tax credits, $2,000 per child. 1,400 or more could be refundable, and the phase outs start at $400,000 married filing jointly, or 200,000 single. The Child Independent Care Credit has also been made permanent. This credit is for working parents who pay for childcare. This credit continues to apply to childcare expenses for children under the age of 13 and certain other dependents. Unlike the child tax credit, the maximum credit rate and phase-out thresholds are indexed for inflation. The 2025 Act also increases the employer-provided child care credit and dependent care assistance exclusion. All right, one of the very exciting new parts of this tax act are the Trump accounts. You've probably heard all about these new Trump accounts. There are two parts to this new provision, which takes effect December 31st, 2025. The first is the pilot program. This pilot program provides a $1,000 government contribution to eligible newborns with a Social Security number who are born between January 1st, 2025 and December 31st, 2028. If an account is not set up by parents, the IRS will automatically set up an account when the child is first claimed as a qualifying child on the personal tax return. Parents do have the option to elect out of this program, so if you do not want to be a part of it, you can elect out. But if you don't elect out, they're going to contribute $1,000 for your newborn. This program provides an immediate head start for families when it comes to saving money for their children. So this is going to be an interesting new part of the Tax Act. These Trump accounts are a new vehicle for early tax-deferred investment growth for children with the potential for significant compounding over time. So newborns are not the only children who will benefit from this program. The second part of this provision is for children under the age of 18 who were born before this program was enacted. Parents can set up Trump accounts for their children, anybody under the age of 18. Only difference here is that they will not receive the $1,000 government contribution. They can still make contributions, so contributions are limited to $5,000 and can be made by parents, relatives, employers, and nonprofits. So there are all kinds of ways we can fund these Trump accounts. The account can no longer receive contributions after the beneficiary turns 18. And an interesting part of this provision is S corporations can deduct contributions made to Trump accounts for employees' eligible children, and employees can exclude up to $2,500 from income. So this is a great part for tax planning. If this is something you are interested, get with your CPA. Let's talk about how this can benefit you if you do have an S corp and you do have children. Typically, distributions are not allowed until the beneficiary turns 18. The tax treatment of distributions will be similar to the tax treatment of IRAs. Since the account grows tax deferred, distributions after the age of 18 generally tax at ordinary income rates, with exceptions for rollovers. The IRS also provides important rules for how these accounts can be invested. So you can invest it however you want. So the accounts must be invested in low-cost, diversified U.S. equity index funds with annual fees capped at 0.1%. So you can't go over 0.1%. Of course, if you're interested in opening these accounts, contact your financial advisor, contact your CPA, get more information. We're going to wrap up the individual portion with the update to the estate and the gift tax exclusion. The 2025 Tax Act increased this exclusion to $15 million and will be adjusted for inflation after 2025. The gift tax exclusion remains and is indexed for inflation each year. So the 2025 exclusion amount is $19,000 for gifts. We have discussed quite a few changes to the federal tax law. I think it's going to be very interesting to not only see how this plays out for federal taxes, but also how the states are going to react to some of the new deductions. I feel like there are quite a few new deductions out there, so we'll have to see for all of our clients and people in other states that have state income taxes, how this is going to shake out for everybody. All right, so we've talked a lot about the individuals. We're going to move on to the business tax changes. And our first big business tax change is for the qualified business income deduction. The Tax Cuts and Job Act introduced the qualified business income deduction, a 20% deduction for pass-through entities and sole proprietors. This deduction has now been made permanent. It was set to sunset, but now we don't have to worry about that. It is permanent. The act provides a minimum deduction of $400 with a minimum qualified business income amount of $1,000. So there is a little, some new rules to this deduction. Not going to impact everybody. The phase-in thresholds have also increased. If you're a specified service business, your phase-in thresholds are a little different than somebody who's not a specified service business. So it's good, of course, to speak with your CPA and decide what is best for your business. We also have some changes to bonus depreciation. So business owners have benefited from the bonus depreciation deduction in the past few years since it was introduced by the Tax Cuts and Jobs Act. Bonus depreciation began as a 100% deduction for qualified property. Since it was enacted, there have been scheduled phase downs of the deduction, beginning with 80%, 60%, a scheduled 40% for 2025, and then finally 20% for 2026. The 2025 Tax Act has eliminated the phase down and reinstated the 100% depreciation deduction. The 100% deduction is effective for qualified property acquired after January 19th, 2025. Another very important date to keep in mind, as it does not cover the full 2025 tax year. It is after January 19th. The bonus depreciation deduction is separate from the Section 179 deduction. Bonus depreciation does not have any annual dollar limits and no income limits. So you can take bonus, you can elect out of bonus depreciation also. Lots of tax planning opportunities here. On the same note as the 100% bonus depreciation, the 2025 Tax Act adds a new code section that allows a taxpayer to elect a 100% bonus depreciation deduction for qualified production property in the year it is placed in service. This is not for all commercial property, only non-residential real property that is an integral part of a qualified production activity. So no, not a CPA firm, not a law firm. It has to be a qualified production activity. If you feel you can take this 100% bonus on your commercial property, talk to your CPA before you make that decision, and we are here to help. We have some good news for our C corporation clients. The 21% flat federal income tax rate has been made permanent. This does not apply to S corps, partnerships, only our C corporation clients. So it's a big win there. And there are some updates to the charitable deductions for our C Corp clients. The Tax Act of 2025 has added a new 1% floor to deductible charitable contributions. The 10% ceiling for charitable deductions, previously introduced by the TCJA, is now permanent. So for tax years after December 31st, 2025, charitable contributions in excess of 1% of AGI and up to 10% of AGI are deductible. Similar to individual charitable contributions, any excess charitable contributions will be carried forward for up to 5 years. The business interest deduction is limited under Section 163J. So to keep this very brief and high level, prior to the 2025 Tax Act, the limitation was calculated using earnings before interest and taxes. The Tax Act of 2025 has changed the limitation calculation to EBITDA, earnings before interest, taxes, depreciation, and amortization. This is good news for businesses because this calculation will allow for greater business interest deductions. All right, businesses can now immediately expense domestic research and development expenses. Before this act, businesses were required to capitalize and amortize all specified research and experimental expenditures over 5 years if domestic or 15 years if the costs are international. So now businesses can deduct these domestic expenses in the year they are paid or incurred. If the R&D expenses are foreign, they must still be amortized over the 15 years. The Advanced Manufacturing Investment Credit, commonly referred to as the CHIPS credit, was implemented to incentivize investment in the U.S. semiconductor or semiconductor equipment manufacturing facilities. Prior to the 2025 Tax Act, this general business credit was 25% of the basis of qualified property placed in service as part of an eligible advanced manufacturing facility. Qualified property does include buildings and structural components. The facility's primary purpose must be manufacturing semiconductors or semiconductor manufacturing equipment. The 2025 Tax Act has increased this credit to 30% of the basis of qualified property. There were no changes in eligibility requirements, phase outs, or the definition of what qualified property entails. The paid family and medical leave credit is a federal tax credit that is available to employers who voluntarily provide paid family and medical leave to their employees. It was originally established under the Tax Cuts and Jobs Act, so the 2025 Tax Act made this credit permanent and applies to tax years beginning after December 31st, 2025. This credit can either be calculated based on wages paid to employees on leave or premiums paid for insurance policies providing paid family medical leave. The credit rate and maximums are unchanged, but the 2025 Tax Act did broaden the eligibility definition. Good news to those who are required to issue 1099s. The reporting threshold has been increased to $2,000. This applies to payments made after December 31st, 2025. The thresholds will be indexed for inflation beginning in 2027. So for the next few years, we can anticipate a $2,000 reporting threshold. The qualified small business stock exclusion applies to non-corporate taxpayers who own stock acquired at original issuance after July 4th, 2025 from a C corporation. The maximum aggregate gross asset limitation for a corporation to qualify as a small business for QSBS or qualified small business stock purposes has increased from 50 million to 75 million. Investors no longer need to hold the stock for more than 5 years to benefit from this exclusion. There is a 3-tiered exclusion schedule now in place thanks to the new Tax Act. You can see 50% exclusion after 3 years of holding the stock, 75% after 5 years, or 4 years, and 100% after 5 years. The exclusion cap has been increased to either 15 million per issue for stock acquired after July 4th, 2025, again, another date, or 10 million per issue for stock acquired before July 4th, 2025. So July 4th, 2025 is the key date for the small business exclusion for this stock. International taxation. There have been some changes to the international taxation. We are not going to go into detail. If these apply to you, contact your CPA. But the TCJA did reform some of the international rules, such as the global intangible low tax income. These reforms have now been made permanent. So if you have foreign source income, contact your CPA to go over changes specific to your tax situation. And we have some expiring incentives related to our clean vehicles and such. So let's go through those. We have the new clean vehicle credit and then the previously owned clean vehicle credit. So for a qualified buyer who purchases a new or used clean vehicle, they will no longer be able to take a credit for the vehicle if it's purchased after September 30th, 2025. It's cut off September 30th, 2025. If you want a clean vehicle, buy it before then. The credit for qualified commercial clean vehicles is also expiring as of September 30th, 2025. Energy efficient home improvements made by taxpayers prior to the 2025 Tax Act were eligible for a credit equal to 30% of the expenditures. This credit expires for property placed in service after December 31st, 2025. Same thing for the residential clean energy credit, also expiring for expenditures after December 31st, 2025. The credit on energy efficient home expenditures and commercial building expenditures are expiring for construction costs incurred or homes acquired after June 30th, 2026. Have a little bit more time for these credits. They expire next year. We have put together a quick summary of the expiring incentives, just so you can see the prior expiration date. For most of them was 2032, but now we have expirations ranging between September 30th, 2025 and June 30th, 2026. These are great to keep in mind if you are planning on making any purchases before then. All right, I will provide a quick summary of all of these tax updates we have quickly gone through at a high level, if you are still here. So we have the permanent extension of the TCJA individual and business tax cuts, lower rates, expanded tax bracket, and QBI is staying. The estate and gift tax exclusion has been increased to $15 million, indexed for inflation, of course. SALT deduction, state and local tax deduction, the cap has been raised to 40,000 for 2025. And then, of course, we've got some phase outs for the high income taxpayers. New temporary deductions for tips and overtime pay are expiring after 2028, but we can start using them this upcoming tax season. And our reporting thresholds for 1099s have increased from $600 to $2,000. Big increase there. We have the sunsetting of energy-related credits and deductions for 2025 and 2026. We talked a lot about those dates. And then we have the permanent repeal of the piece limitation, 100% bonus depreciation, and then an updated and expanded qualified small business stock gain exclusion. Here's some more effective dates. I feel like we threw a lot of effective dates at you. They are going to be pretty important here because they're not all the same date. So most provisions are effective for tax years after 12/31/2025. Bonus depreciation, the property had to be acquired after January 19th, 2025. The $2,000 reporting threshold coming up for next tax season. Again, the energy credits and deductions, we talked a lot about those dates. The overtime and tip deductions are good for 2025 through 2028, temporary deduction. Employer child care credit was enhanced after 2025, and the excess business loss limitation was permanent after 2026. All right, so in conclusion, we saw that the 2025 Tax Act provides major tax relief and simplification for individuals and businesses. We've got some enhanced credits and deductions, some of them temporary, changes to international tax and reporting, and then the transition rules and effective dates for compliance and planning have been reviewed, and of course, something that as a CPA we'll go over with you at year-end tax planning. If you want a great read, you can read the full text of the Act and the IRS guidance for any implementation details. All right, Austin, you want to finish this up?
Wow, that was a lot, Erin. Thank you. And thank you so much to everyone who tuned in and made it this far with us. That's going to do it for this quarter's tax update. If you'd like to speak to someone on our team about your individual or business tax situation, or if you're interested in learning more about how the FSA team works together to meet client needs, feel free to reach out to us. You can visit our website or contact us directly using the information below. Thank you all again on behalf of the whole FSA team. We look forward to connecting with you soon.